bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the January 30th, 2024 podcast. If my voice sounds a little scratchy, I was at the San Francisco 49ers Detroit Lions game yesterday, and there was a lot of screaming, a lot more in the second half than in the first half. But let's get back to the podcast. Developers, investors, syndicators, and others in the low-income housing tax credit community will want to pay particular attention to today's podcast. This episode is being recorded on Monday, January 29th, and it's the 12th in the latest installment in our So You Want to Be a LIHTC Developer series. This series is designed to help real estate developers learn more about the nation's most effective affordable housing production and preservation incentive, the low-income housing tax credit. Now, the low-income housing tax credit is generally claimed over a 10-year period. Now, I say generally because in the first year of the 10-year credit period, an owner can only claim tax credits to the extent units are occupied by low-income households. And any credits not claimed in the first year are eligible to be claimed in year 11. Now, rarely is a property placed in service and fully leased for the entire calendar year of that first year. As such, the topic of today's podcast is how developers can maximize their first year tax credits. We're also going to explain why the amount of tax credits claimed in that first year can be so financially significant to the partnership that owns the property and the developer developing the property. Now, as our viewers on YouTube can see, my guest today to discuss this topic is Dayle Dalling, a partner at Novogradac's Philadelphia Metro office and one of Novogradac's experts on the low-income housing tax credit. We do have a lot of ground to cover, so if you're ready, let's get started. Dayle, welcome to Tax Credit Tuesday.
Thanks, Mike. Pleasure to be here.
Well, it's great to have you here. And before we get started down the road of explaining the calculation of first-year tax credits, I thought I'd ask you to describe for our listeners the services that you provide to clients of Novogradac.
Yeah, so I focus primarily in the low-income housing tax credit and the historic tax credit, and really do any service that is related to that, whether it's some general consulting early on through helping with projections, reviewing projections for the client, to the annual audits and tax returns that are required every year for that.
Great. Thank you for that. And I will include your contact information in today's show notes so listeners can reach out to you. So let's first start with the why we care. If you could explain to our listeners why maximizing tax credits in that first year can be financially significant to developers and investors.
So as Mike, when we're looking at the first year tax credits, the amount of credits that property is able to claim, it can have a significant difference because every partnership agreement is going to have what we refer to as the tax credit adjusters built into that language. And as a part of that tax credit adjuster, depending on the timing and the amount of those first year tax credits, it often can have a pretty significant adjusters or just value to that investor that's looking to pay for those credits. If the time value of money plays into that, and if they're going to get more credits sooner, it's going to have a good monetary value for those developers.
That's a good explanation because, as I mentioned in the intro to our listeners, whatever credit you don't claim in the first year, you claim in year 11. And obviously, would you rather have a tax credit in year 1 or year 11? The time value of money, as Dayle mentioned, you claim that in year 1, that's going to be a lot more valuable than claiming it in year 11. And in terms of adjusters, Dayle, what portion of agreements, partnership agreements that you work with your developers have tax credit adjusters with respect to year 1 credits?
I can't think of any that I've seen that don't.
100%.
100%, exactly, yeah. And I think every time, in the actual playing out of how things play, there's always some type of adjuster that is getting calculated when we're doing those first year tax credit calculations.
And then these adjusters are adjusting the capital contribution that the investor has to make,
Correct.
or downward adjusters, which is basically if you have fewer first year credits, then the investor is going to put less capital in order to compensate them for getting credits later. How often roughly do you see upward adjusters where if it turns out there are more credits, the investor will invest more?
So it's definitely not as common as the downward. I think we see the downward adjusters because especially recent years with the construction delays and different things that have kind of pushed things off, we're seeing more of the downward adjusters generally. But on occasion, I don't know.
Right.
It's hard to throw a percentage on it, but it's definitely a lot less common to see those upward adjusters than the downward adjusters.
No, it's definitely hard to throw percentages out there. And I would note to our listeners that we're talking here about upward and downward adjusters for the first year credits. There are also adjusters for the absolute amount of tax credits you're going to claim over the 10-year period. And they can be upward and downward adjusters as well. And then there's other commitments that developers make, which this isn't all about adjusters and other commitments developers make in the context of developing tax credit transactions. We're narrowly focused on first year adjusters, but I did want to lay the stage with that. So now we can move to the mathematical question. And so many things that I think about algebraically. And there's sort of an algebraic calculation that's involved in determining the first year credits. So if you could explain to our listeners at a pretty high level how credits are determined in the first year, and then we'll go into a number of different situations developers can face that have different implications for how credits are generally calculated in the first year.
So from a high level, there's really kind of two key factors when you're doing that first year credit calculation. One is when the building was placed in service. And then the other is when it was leased up with a qualified tenant. And then also keep in mind, this is a building by building calculation that is done as well.
And when we talk about the first year, many developers are very aware that you look at the percentage of the property leased in most tax credit transactions. A lot of them, I was going to say most, are going to be 100% 100% affordable. So 100% of the units we lease to qualifying tenants, and they'll basically take the eligible costs that go into the tax credit calculation times their low-income occupancy percentage. And that will be their qualified basis. And basically in years 2 and beyond, you basically will calculate your qualified basis as of the end of the year. And the qualified basis determines how much tax credit you're entitled to. In the first year, you basically are doing that calculation every month. And as Dayle pointed out, each month you have to look and say, what portion of my units were leased to qualifying individuals as of the end of the month?
Right.
However, as Dayle mentioned, you also have to have the entire building has to have been placed in service for the entire month. So you're on a building by building basis, you're doing this monthly calculation where the building has to be in service the entire month. And then you look to, if that's the case, then you look at the occupancy as of the end of the month for that building. And it's important, as Dayle pointed out, that it's a building by building test, not a project wide test.
Correct.
So now I wanted to talk a bit about calculating first year credits based upon the type of property being developed, as well as how they're able to claim, what entitles the developer to claim tax credits with respect to the build. Now, in terms of the manner in which a property is entitled to claim tax credits, there are essentially two ways that a property can generate tax credits, or at least have the right to generate tax credits. Those that receive a tax credit allocation, often referred to as allocated credits or 9% credits. I'm always a little anxious calling them 9% credits, as Dayle, when we are preparing for the podcast, because if you get an allocated credit from the credit allocating agency, which is generally at the state level, you're generally allowed 9% as a credit percentage on new construction and qualifying renovation costs. However, if you're getting an allocated credit, but you're doing an acquisition rehab, then you're entitled to 4% tax credits on your acquisition costs. So we're going to refer to this as a 9% credit or allocated credit. Just know that you could get 4% credits on your acquisition costs of snack rehab. The other way in which a property is entitled to tax credits is if they're financed by tax-exempt private activity bonds, and they're going to be eligible for the 4% credit on acquisition, renovation costs, or new construction. So it's never 9% when you're financed by private activity bonds. So when I think about the first year credit calculation, I think of 9% credit transactions, allocated credit transactions, or 4% bond finance transactions. But I also think about either new construction or acquisition rehab. So I think of it in almost 4 quadrants. It can be 9% new construction. It can be 4% new construction. It can be 9% ac rehab, or it can be 4% ac rehab. So let's break out this discussion of those 4 categories. And we'll start. I'm not sure that there's one that's the easiest, but we got to start at one of those quadrants. So let's start with new construction and 9% allocated credit transactions. So Dayle, if you could explain to clients what they should be thinking about in prospective clients and other listeners, what they should be thinking about in terms of maximizing tax credits in a 9% allocated tax credit new construction transaction.
Great. Thanks, Mike. Yeah. So as we were mentioning, when you're looking at the first year credit calculation, you have to think about that applicable fraction. What percentage of the units were placed in service during that first year? And it's rarely a full year. It's usually going to be some percentage of that. And then you take that percentage and you look at your total eligible basis. With the 9% allocated credit, as you were mentioning, there is a fixed amount of credits that you can take in any given year. It's not limitless. There, when you get that allocation from, like you said, it's often the state allocating agency. It's a fixed amount of credits per year that you can claim. And so as you're looking at this calculation, you can use a concept of what's called excess basis, is what we usually refer to it as. And basically what that means is you have that fixed amount of tax credits you can claim in a given year. And if you back into it using the 9%, then there's essentially a fixed amount of basis that you need to be able to claim those credits. However, in the first year, when you're claiming those credits, if you have basis in excess of that amount needed to generate the fixed amount of tax credits, then you're able to get closer to that number. Because usually, let's say that your first year applicable fraction was 50%. And you need to have $1 million of basis to generate the amount of credits that you've been allocated. But let's say you have 1.2 million of credits. So it's not that you're going to generate more than your fixed amount of credits that you were allocated, but you might be able to take 50% of that 1.2 as your basis to then times it out by your credit percentage. And it can increase the amount of first year credit that you're getting, as long as it doesn't exceed the fixed allocation that you were provided. And so that's one of the things when you're looking at that. So with 9% credits, one of the things that you're trying to do is get those buildings placed in service as soon as possible, and make sure that once they're placed in service, then you're getting them leased up at least by the end of the month, that you're able to get them leased up and qualified so they can then start generating those tax credits, and so that you can get that applicable fraction as high of a percentage as possible. And so I think that's kind of the big picture of how that's done on that.
I definitely think, as you pointed out, the fact that on a 9% credit transaction, generally speaking, the states will be allocating you a tax credit amount. That means implicitly that you have excess basis going into the transaction. Or said differently, theoretically, you could be eligible for more credits, but for financial feasibility, you don't need that maximum allocation amount.
Right.
So you're going to have excess basis on a go-forward basis. And the fact that you have that excess basis means when you're doing that first year calculation, your local occupancy percentage can be lower, but your excess basis is higher, so that your qualified basis, if you will end up being slightly higher, but you need everything to work out by the end of that first year credit period. The only other thing I would sort of add here is the whole notion that since this is a building by building test, you're doing a local occupancy percentage building by building. You're trying to lease up the buildings as quickly as possible. You won't claim credits unless the building's in service for the entire month. So you're definitely, if the building's not in service for the entire month and another building was, then a tenant in that other building will give you tax credits for that month. Whereas the one that if you lease up in the building that's only in service part of the month, you won't get tax credits for that period. So on a leasing effort perspective, you definitely want to be focused on the buildings that are placed in service for the entire month. And then there can also be issues where you have multiple buildings straddling a calendar year. And that's where a lot of clients will be very focused on only claiming credits on the buildings 100% leased by the end of the year. And then, some credits in 1 year, having basically multiple first years because it's building by building. But a lot of that's sort of more advanced. And I don't want to talk about it more than I can whet the appetite and let the clients and listeners otherwise reach out to you, Dayle. So we've talked about, so that's the 9% a credit transaction, which is really focused on the fact that there's this excess basis that can help you in the earlier phases of the lease up. Now let's turn to private activity bond finance transactions. And as many listeners know, for private activity bond finance transaction, there's this 50% finance buy test that you have to meet. But as a general matter, you're not going to be capped on tax credits because generally there'll be a theoretical amount that you're entitled to based upon your eligible basis. And normally private activity bond finance transactions have financing gaps. So the state agencies will allow you to claim the maximum possible. So you won't have this excess basis point, but there are other considerations that, or at least one other major consideration that we talked about, if you could share with our listeners.
Yeah. So like I said, with the 4% transactions, as we generally refer to those, the big consideration there is really that financed buy test, which currently is at the 50%. And so that's the thing that you really have to focus on, because if you end up failing that financed by 50%, then you lose the ability to claim credits on the entire eligible basis. It restricts you back to only being able to claim credits on the amount of that eligible basis that was financed by the tax exempt bond. And so when you run into that, it's essentially the easy calculation is you lose half your credits. And as we talked about in the beginning with credit adjusters, if you lose half your credits, that means you probably lost half your equity, and or roughly, depending on how that adjuster is calculated. And usually if you've lost half of that equity coming into the deal, it's going to be really hard to replace that financing with some kind of soft financing source. And so it can be really detrimental for the property if you fail that finance buy. So that's really the biggest thing, because it's not always about just getting that basis, that eligible basis as high as you want. You got to make sure you're watching that finance buy test, because that's very critical for the 4% deals.
So thank you for that. Now we're going to turn to acquisition rehab. So we've talked about new construction allocated, new construction private activity bond finance. Now we'll discuss AC rehabs. And let's look at allocated credit transactions that are AC rehabs. If you could explain to our listeners how in low-income tax credits, when you're doing the acquisition rehab, you obviously have physical buildings, and you go in and that's a physical building. There's one building there and it's being renovated. However, for tax credit purposes, there's this fiction of having two buildings. So if you could explain to our listeners this fiction of two buildings in an AC rehab and why that's significant when calculating first year tax credits.
Yeah. So like you said, there's the way that the credits are awarded with acquisition rehab properties is you get essentially an award or an 8609 on when the things are complete for each piece of that. So the acquisition is going to be treated as a building and receive its allocation. And then your rehabilitation will be treated as a separate building. So essentially each of those buildings are going to have two separate allocations they're getting, and two separate 8609s that they get at the end when they're placed in service. And so it's important that you're kind of keeping track of that. and differentiating those as you're going through. The other big thing that you have to kind of watch for with those, as you mentioned, you've got the rehabilitation happening, and that is going to usually happen in two different ways. Either you're going to acquire an empty building and then rehabilitate it and get it placed in service, lease up, or the other way that I've been seeing more commonly recently as well is that you're going to acquire this building and then you're going to do what we refer to as a rehab in place. And that is essentially that you're just kind of moving tenants around while you rehab those buildings. So it's going to be occupied while you're rehabilitating it. And the reason it's important to keep the distinction on that is when you're looking at that first year applicable fraction, that first year credit percentage that you can use, the rehabilitation has to look to the acquisition piece and essentially use the same percentage when they're doing that. And so it's important that you make sure that you understand how that works, and the acquisition or the rehabilitation can take credits back to whatever the place and service date of that acquisition was. We can refer to that as the tack back rule. And so even if the rehabilitation wasn't completed until September, let's say, if the acquisition was acquired in, you know, May, then that rehabilitation can assume that place and service date of May and be able to use that in the calculation of that first year credit percentage when you're doing your first year credit calculation.
That's a good explanation, because I mentioned in the intro how seldom is a property placed in service and fully leased for the entire year. One exception would be with an AC rehab, where you buy the building in 1 year and you qualify all the tenants, and then you work on the rehab that gets placed in service in the following year. And as you pointed out, the loan occupancy percentage for the rehab will look to the loan occupancy percentage for the acquired building. And since it was 100% leased when you bought it, then when you go to the next year, it's 100% leased as at the beginning of the year. So you basically, in those situations, would get a full year's worth of credits, which is most notable.
I would add, like you
Please.
said, I think that is the one time when you might see an actual full year of credit, is if that acquisition goes over the end of a year like that, and then you're able to tack back to that. Yeah. Otherwise, like you said, I don't think we've ever seen a full year of credits in the first year otherwise.
So now let's talk about AC rehab if it's financed by private activity bonds. If you do an AC rehab as allocated credits, you could still have excess basis in the rest.
Correct.
So all those calculations sort of are still applicable, as you discussed earlier, albeit it's a lot more complicated when you have the two buildings versus one building and all the rest. But once again, maybe we'll have a 202 podcast at some point, but we won't go to that now. With an AC rehab financed with private activity bonds, you won't have this excess basis situation arising as likely. I'm sure listeners are thinking, well, you probably still have the 50% financed by test to be considered. Right. Are there other considerations or anything else more you'd want to say about that in this context?
I don't know in this context. Like I said, there are other considerations that kind of get more into the 201 level on some of that. So it's really just the finance buy is kind of the main difference, I would say, still between the AC rehab for a 4% versus a 9%.
Right. Thank you for that. So now that we've discussed the 4 different categories and the first year calculation sort of among the 4, I feel like we covered a lot. I always feel like the AC rehab is the more challenging of the 2 concepts as opposed to new construction, particularly if it's an in-place rehab where you have the quote tack back rule applying. Are there other items that you wanted to point out to listeners before we bring this to a close?
I think the main thing that I would say is just when you're looking at your 50% or your 4% deal, it's that 50% that you really want to make sure you're paying attention to that. I think that's where I get a lot of my questions from. And I see a lot of properties or developments out there where they sometimes they might have an easier piece of financing they can go out and get. And it's easy to say, oh, well, this is a soft debt. It's easier to use that. So I'm not going to draw my bonds down. Like, don't forget to always make sure when you've got that financed buy, you want to make sure you're getting those bonds drawn down, that they're getting used for hopefully construction hard costs, because you want to make sure they're using that for that, and just keeping that in mind. And the other thing I would say is, you're looking, we kind of touched on a little bit, when you're leasing buildings up, and this kind of goes for either type of property, you want to be looking, which ones were placed in service. And if I've got one that maybe wasn't placed in service in time, let's make sure we're leasing up the correct buildings, because getting that maximum occupancy percentage in that first year is critical to maximizing those tax credits.
And I would always give the general disclaimer, there are other rules in place. There's fair housing rules and all the rest, and you're leasing and all of that. So obviously you have to be satisfying a lot of certain requirements. So make sure that you're doing your lease up in accordance with all of those rules.
Correct.
And I would probably just add that it's important to bear in mind that there is an adjuster in your partnership agreement, and the first year lease up does matter, and someone should be responsible for knowing what your promises were with respect to first year. Are there upward or downward adjustments for first year, and make sure that you're aware of the financial consequences, so you can take whatever actions are needed in order to maximize those first year credits. And I would just also say there are a number of other sort of techniques and options that developers have in that first year with respect to tenants, leasing up tenants moving, and the rest between buildings. But I don't want to go into all of that.
Yeah. Offering incentives to make sure and get someone in. There's a lot of different, like you said, tactics to be able to utilize.
That's right. And it's just important to understand what the financial consequences are.
Right.
And that can end up affecting your behavior. And it's also something as simple as getting your certificate of occupancy on the end of the month versus the second day of the month. But you might think it doesn't really matter. But if you get it January 31st, you can get a full month of credits in February. If you get it February 2nd, you won't get the full month in February. Before we bring this to a close, and I have a couple of off mic questions for you, but maybe you could share with our listeners some other resources that they should know about while I try to clear my throat.
Yeah, problem. Yeah. So that we've got we do have a webinar on first year tax credits and lease up. I don't know if we have one upcoming, but I know we've got one that's on demand that you can go out and get. We also have our Novogradac 2024 Affordable Housing Conference in San Francisco coming up May 2nd and 3rd. We have our LIHTC working group that is a great resource to kind of stay up to speed on things. And then you can't find it there, just reach out to me. I can also help you out.
Thank you, Dayle. I will include a link to your contact information and the other resources that I and you mentioned in the show notes for this episode. And now I'd like to move to our off mic section, in which I get to ask you some fun off topic questions, and you can share some advice or words of wisdom for our audience. And the first, I'll ask you two. The first is, what's the best professional advice that you've ever received? And I say that every week I'll say best, then I'll correct myself and say, not really best. Give me some real notable, because best it's hard, and you've received more than one notable piece of professional advice. So just share one that you would most want others to know about.
Yeah, thanks, Mike. I think the one that I would like to share is focus on what you can control. And I'm not going to say that I'm perfect at that yet. It's something I still try to work on, and remember that there's certain things that are within my control, and that's what I need to focus on. Those things that are outside of my control, don't let that bring extra stress or frustration to you, because if it's not in your control, there's nothing you're gonna be able to do about it, and you're gonna just drive yourself crazy. And so focusing on what you can control, I would say, is probably one of a big piece of advice that I've received.
Yes.
Helped.
You might think you control things you can't control, and you might believe it's just things you can control. That's always a challenge as well.
Yeah.
So I also like to get book recommendations or movie recommendations or some recent series, podcast. So if you had any recommendations in those broad categories, is there one or two that come to mind that you would say you would like to point out to our listeners?
Yeah, there are a couple. This last summer, I actually had a book referred to me and read and really liked it. It's called Quit by Annie Duke. I don't know if you've heard of that one or not yourself, but it kind of talks about making sure that you're analyzing things and not forgetting to exclude sunk cost concepts. And it has a concept that they bring up called the kill criteria, essentially saying at what point is something not really benefiting you anymore, and so should you stop doing that? And they kind of talk about that from both on like a personal and even a professional level on that. And so that's been a really good one, a really good book that I have enjoyed, and it's helped quite a bit. And then
just before you get to the next item,
Yeah.
because she also wrote the book Thinking in Bets, and I have read that one. So if you recommend Quit, I'll add it to my Goodreads list.
Yeah, no, Quit was a good one. I really enjoyed that one. So I still need to go. The Thinking in Bets is one of the ones that's on my list that I need to go read. So, and then a movie recommendation. I actually just last week went and saw the Boys in a Boat movie, and really, really enjoyed that one. Talking about a rowing team that University of Washington ended up making it to the Olympics. It was a story that I wasn't very familiar with prior, but it was a really good one. So I really enjoyed that.
Great. Well, thank you, Dayle. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.